today we have our third class about stock trading, and it will consist of two parts. First of all, we'll discuss common mistakes which some traders sometimes happen, and then we'll discuss trading strategy. What is a trading strategy, and why do we need a trading strategy? Okay. We'll start with common mistakes. Why do we need to start with common mistakes? First of all, because one mistake can ruin all your trading balance, and sometimes after, let's say, 10 successful deals, one mistake may decrease your profit or even increase your losses. So with let's say 10 successful deals and one mistake, still you will be able to lose some money. And why should we study mistakes? During the first class I mentioned that actually on the stock market 90% of traders lose money and only 10% of traders earn money. So we will study common mistakes to avoid being in 90% of traders. And during the second part of the class, we'll study trading strategies, and so we'll study strategies how we can be in 10% of traders. And the list of common mistakes, it's a very long list. And today, first of all, I would like to let's say, come back to the previous class when I forgot to bring prizes. And last time we had two people who earned prizes. Are they here today? Yes, one of them. And who was the second one? Okay, we have prizes, so the prize for previous class goes to you. Please pass it. Okay, and today we also have prizes for today, prizes for the class. And okay, we will go in this way. The list of trading mistakes, it's a very long list. So it consists of, let's say, a lot of different mistakes. And we have price for each mistake. So now you can try to name a mistake, a trading mistake, according to your intuition, and if you're right, you will get a prize. Okay, who wants to be the first? Yes, please.
One of the common mistakes might be buy low, sell high.
Buy low, sell
at a low price, sell at a high price.
Okay, yes, this is one of the mistakes.
Why? Sounds right.
Yeah. Can you repeat that?
Because you're not looking at the prices, you're looking at trends or basically what the company is doing.
Okay, yes. So who wants to be the second one?
Can you explain what? Can you repeat one more time?
Okay. We will get back to the list of mistakes in the presentation, so you will see all these mistakes written on the slides. Okay. Yes. Sorry. Penny. Okay. Okay. Let's say it's about emotions, but this is also right. Okay. You get another prize. Okay. Yes. Who is next?
Trading without system or strategy.
Yes. This is one more mistake. Okay. Who wants to be the next? Sorry.
Following common strategy that right now in the market.
Yes.
What?
Okay. So that mistake was about following a common strategy on the market, which is available on the market. Following common strategies.
Reversing your position.
What does it mean?
It means you've already taken one position, you think it is wrong, then you reverse it, and then at the end of the day you find out, oh, that is also wrong.
This is something like trading without a strategy. So this has been mentioned before. Okay. Yes.
How many prizes?
Sorry.
Counting past losses.
Sorry?
Counting past losses.
What do you mean here?
Taking into account them. For example, if I already lost 10% by investing in this organization, I would think, well, I already invested that amount of money, and I can invest more, and maybe in the future I can get them back.
Okay, this is not quite really a mistake. This can be, okay, this can be either a good decision or a bad decision. It depends. So we can't, you know, say that this is a mistake. Usually, okay. Who's next?
Can I?
Yes, yes.
So it's like playing a poker. When you don't calculate the risk versus reward ratio, then
Yes. So not following math.
yes.
This is right. Okay. Would like to be the next? Okay.
How many prizes are there?
Quite a few.
A lot of prizes. Yeah.
Probably assuming that the trend will continue go this way infinitely long. Like you were saying that, oh, it falls down, so I'll wait even more and more and more until it goes even lower. Okay.
Okay, yeah. Actually, this is one of the mistakes when I would like to rephrase it. It's a situation when you do not fix losses. So if the price decreases, you think that, okay, it will reverse, the trend will reverse, but still it will not reverse. Okay. Yes, please.
When you are investing at one time a huge amount of money of all available, I mean, the part of investing is really huge comparing to the whole money you have.
Okay, yes, so this is also one of the mistakes. It's a situation when you invest a lot of money in one stock. Please pass it. Okay. Yes, please.
Using an unreliable internet connection.
When I was preparing for the class, I didn't think about this mistake, but actually this is one of the mistakes, and actually I did such a mistake twice during my trading career. Yes.
Oh, this is a mistake you did.
Yes. Okay. Yes, please.
Not paying attention to outer world's environment, like politics, economics.
Great. Okay, and yes. Okay, and I have one prize left.
Maybe on
Okay.
the contrary, to listen carefully all news and react in all news that could be fake.
Could you please repeat it? So.
To react to fake news. I mean, to react immediately to news, and like you said last time, you have to remember that everyone knows that news.
Yes, okay. This can be one of the mistakes. Okay, great. And now after we distributed all prizes, we're ready to look for the slides for all these mistakes. Okay. Actually, I have a list of 12 mistakes. And actually, the 13th mistake was mentioned. It's about using not reliable internet connection. So first of all, let's assume that, okay, you have a reliable internet connection, and there is no problem with your connection to the stock exchange. There is no problem with your broker. And that we are talking just about the process of how you submit orders to the stock exchange. So there is no problem with internet connection, no problem with brokers, no problem with trust between you and your broker. Your broker doesn't change your orders, something like that. He will go to jail if he changes your orders. Okay, and there are 12 mistakes in terms of trading. Here we can see the first 6. trading without a strategy. This is one of the most, let's say, important mistakes. And the second one, using random trading approach, they go together. They are almost, they are very similar things. The third one, it's about not reading news about general politics, general economic situation. The fourth one, it's about competing with machines in reading news. So, for example, if you would like to, sometimes if you try to, let's say, to react to news as fast as possible, it is also a wrong strategy, because there are robots which usually react faster than you. The fifth one is lack of discipline, and 6, emotions instead of math and logic. Here is a list of six more mistakes, and now we will go through this list for each mistake one by one, and I will try to describe you each of the mistakes, and I will try to give you some real-world examples. Okay. The first one, it's about using random trading approach. You know that you can go to Las Vegas if you like to gamble, and you know that in all places like that, the math expectation of your profit is negative. Yes, please.
Ron, play blackjack.
Okay, let's say.
Ron, it was 20 years ago.
You can count now.
Not
You
now.
can.
Not now.
Yeah.
Let's take more traditional games like this one. Okay, sometimes it is possible to, let's say, count, but still let's take very simple games. And in these very simple games, the math expectation of your profit is negative. It means that if you apply a random trading approach and you do just random things, your math expectation is negative. What does it mean? It means that if you are lucky, during your first, let's say, 5 or 10 deals, you will be able to be profitable, if you are lucky. But in the long run, if you are playing with negative math expectation, with a very high probability, your profit will be negative, so you will lose money. Okay. The second mistake, it's about trading without a strategy. When you're trading without a strategy, it is something like you're trading when you are making just random actions. And this is very similar to the previous point. What is a trading strategy? Actually, it is, let's say, an algorithm of how you make decisions. We'll discuss this term during the second part of the class. Okay, the third mistake. It's about ignoring news. So this is about ignoring some, let's say, general news like political situation, general economic situation in the country. And it is dangerous because sometimes you know that in economics there is a theory about economic cycles. And sometimes the GDP, gross domestic product, is increasing, sometimes it is decreasing. And under these circumstances, if you know that now the GDP is decreasing and the economy is in a recession phase, in this situation it is dangerous to open long positions. It is dangerous to buy stocks because you know the general trend in the whole economy is a decreasing trend. And in order to identify the state of the current economic cycle, it is a good idea to read news. For example, now, let's say that the GDP of Russia is decreasing. So if you consider investments of maybe 1 or 2 years, now it's not a good time to invest for 1 or 2 years, because the theory of economic cycles says that the duration of one cycle is approximately 7 years, and there are phases of increasing, there is an increasing phase, a decreasing phase. Now we can identify that there is a decreasing phase in the Russian economy, even according to statistics. And in this situation, you know that it usually lasts for 7 years. In this case, now it's better to wait for the increasing stage. Okay, the question?
Yeah, did we have a increasing stage previously?
Actually, yes, because the previous crisis was in 2008, 2007, 2008, 2009. After that, let's go to an example. There is a large company called Sberbank, which is the largest bank in Russia, and we can let's say see the price of its stocks. So during the crisis of 2008-2009, the lowest price was approximately 15 rubles per share, the lowest price. After that, it restored to, let's say, in 2010, 2011, it went to 80 or 90 rubles per share. So we can see that in 2008, 2009 there was crisis, and then there was an increasing phase, and the price for one of the largest banks and companies in Russia increased approximately 5 or 6 times. Okay, and now we can see that the current price for Sberbank is approximately 62 or 63 rubles per share. So we can see now that the price is lower than it was in 2010, 2011, 2012, but still it is not so low as it was in 2009. Okay, that is why it is just my advice that if you'd like to invest for, let's say, a year or 2 years, now it is not a good time for this, for the investments of this period, for the Russian market at least. Okay. The fourth mistake, it's about competing with machines in reading news. So we mentioned previously that there is a mistake when you do not follow the general economic situation. Another mistake is a situation when you try to follow news in real time. It means that you try to trade using, let's say, seconds or minutes. In this situation, we can see that you will be competing when you are trading during seconds. So you, for example, you buy stocks in 10 seconds, you sell stocks and try to get some profit from these 2 operations. In this case, you will be competing with high-frequency traders and with machines which read news. And it would be very hard for you because you can't, let's say, you can't process news during 2 milliseconds, while machines, they can. Just for statistics, yesterday I tried to look for some statistics about the percentage of deals which are made by robots on Moscow Stock Exchange. And as of 2010, approximately 55% of deals were made by robots. It means that more than half of total number of orders and deals are made not by humans. In this situation, you see that it would be hard for you to compete during seconds. So my advice is for you to compete during, let's say, hours or days. Okay, a question?
Yeah, is it by volume or by number?
By the number of deals. So if we buy let's say, by the number of stocks. by volume.
Okay.
So if you submit an order for buying Sberbank, for buying 100 stocks of Sberbank, this is equal to volume of 100. Okay. And more than that, there are not only machines on the market. Sometimes there are insiders, and this is This is prohibited. But still, let's say, sometimes there can be a situation when something prohibited happens. In this case, some people may go to jail, but still you will lose money and And at the same time, we can understand that when you are looking at prices on the stock market in real time, there are, on the Moscow Stock Exchange, there are thousands of people who are doing the same thing. And in this case, it means that if you are reading news in the real time, thousands of other people also read the same news real time. And in this case, it's a competition of who uses his mouse or keyboard quicker. And this is not the way you would like to compete. And as a result, this is a common situation when you read news, but you read a good news about a good company, but it is already time not to buy, but to sell. And there is a very good theory about information distribution. It is called Elliott's theory, and we'll cover it during the 5th class, I think. It is an advanced theory, and it is widely used by advanced traders today. Okay. Mistake number 5. It's about lack of discipline. It means that you can, let's say, you can make 10 good deals, and each of these deals will get you, let's say, 1% of your money. But then you will make one mistake, and you can lose, let's say, 20%. In this case, you will lose some money if you consider all 11 deals. And just one random action may result in a huge loss. And okay, I can confirm this according to my experience of approximately 3.5 years. This is true. So one random action can result in huge loss. Okay. The mistake number 6, it's about emotions. So we talked about the discipline. Emotions represent the same idea, and sometimes you will have choice between math and emotions. And for example, let's get to an example. You have some stocks, and the price for that stocks decreased for, let's say, 2%. And now you have a choice. You can close that position, you can sell those stocks, fixing your loss, or you can continue to hold that position. And if you, for example, if you do some math calculation, and that calculation will tells you that it is better to close the position because it is likely that the price will be decreasing, in this case you should close that position and you should sell those stocks, even if you have some emotions that these stocks will decrease in, let's say, 1 day or 7 days, something like that. When you have two choices, one of them is explained by math, the other is explained by emotions, you should choose the one which is explained by math, because math is the king. And actually, this is one of the most, let's say, most influential mistakes. Actually, when we say that 90% of traders get losses, it means that out of those 90%, most of them get losses because of this mistake, because they have emotions, and they follow emotions instead of following math. Okay. Mistake number 7. It is about doing what other people do. This is a very interesting type of mistake. We understand, and we should understand, that on the stock market 90% of people lose money, while only 10% of people earn money. And under this certain math, there is a question. If you are trying to copy people, if you're trying to copy a lot of people, if you're trying to follow the majority, in which group will you be after copying other people? This is a very simple question, and I think that you can guess the answer.
With 90% probability.
Sorry?
With 90% probability.
Yeah. Okay. Actually, this mistake is also very important, and we'll see more mistakes about which will be connected with this one. Okay. Mistake number 8. It's about trading without stop losses. What does it mean? It means that you cannot follow the market, you cannot follow the prices on the stock exchange 24 hours per day. Actually, this is very hard. Or maybe you can follow these prices during maybe 1 day or 2 days, but then there will be situations when the market is trading and you are not able to see prices real time and to submit orders to the stock market. And if in this situation you are trading without stop losses, you are under huge risk, because sometimes unexpected situations happen. An example. It was, let's say, 1 week ago. There was news that Elon Musk, who is the CEO of Tesla company, and we remember, according to the previous class, that the valuation of this company is approximately $25 billion. There was news that its CEO sees no profit until 2020. After this news, the price for the stocks of that company decreased by 8%, just during, let's say, several hours. This is an example of a situation when ignoring stop losses can result in huge losses. Okay, this is a company with valuation of $25 billion, and okay, we can get, let's say, an idea that okay, this is a huge company. The price of its shares cannot decline significantly, but still, the price decreased by 8% just during 1 day. How you can avoid having huge losses in such situations? You should put stop losses if you are not able to follow the market during 24 hours, or if you have, let's say, if you have vacations, or if you have a business trip to another country, or if you have something else which bothers you from following the market with your laptop. In this situation, you should put stop losses for your position. It means that okay, we buy, let's say, Apple, or we buy Tesla for $200 per share, and we put stop losses -2%. It means that -2% is equal to stop losses for 196. And in this situation, when you do not have access to your computer, and such a situation happens, your position will be closed automatically, and you will lose only 2% instead of, let's say, 8% or maybe 20%. Sometimes there are situations when when the price of stocks loses 10%, 15%, 20% during just one day. Mistake number 9. This is about putting money, let's say all money or a lot of money or a very huge share, huge percentage of your money in one stock. This is significantly increases risks. So this actually this decision it increases risks. So it can be a good decision if you are sure about the stocks of a certain company. But if you are a beginner on the stock market, the general advice is to avoid such situations and to distribute your money into several companies. During the second part of the class, we will get some advice how you can spread money into several companies. But the general advice for now is to avoid putting all money into one stock. Okay. And just to understand, imagine that you put all your money into Tesla, and according to the previous slide, remember that the price decreased by 8% just during one day. In this case, you can lose 8% during one day, and this is actually a huge loss. Mistake number 10, using robots from the internet. Who can see any connections with any previous slides?
19% and 10%.
Yes, so this is the very direct connection with the slide with 90% of people who lose money and 10% of people who earn money. If you are trying, if you are trying to copy someone's strategy, if you are download a robot from the internet, even if that robot was profitable and it was published when it was profitable. Suppose that someone publishes this robot and or the strategy online. After that, a lot of people will download that robot or that strategy and will use that robot. And you will use it as well. And this is, again, the same question. Where you will be, in which group? In 90% or in 10% if you are trying to use something which is available to everyone. Okay. I hope that you understand the answer to this question and the reason why this is a mistake. Okay. The next mistake. It's about analysts. We know that on the TV there is RBC channel, and 24 hours every day we can see analysts which analysts who have predictions, who have let's say a lot of different arguments why, for example, Sberbank should be the price for Sberbank should be increasing, the price for Gazprom should be decreasing, etc., etc. And okay, the mistake is to follow these recommendations. Why this is actually a mistake? Because analysts, they are usually people who do not invest their money into stocks. This is the difference between an analyst and a trader. So if there is a person who tries to predict the market and he puts his money into stocks, he's a trader. And you will see, on the TV set that there will be, small text saying that this person is a trader. Okay, in this case, you can listen to his recommendations because he puts his money on risk. If it is an analyst, in this case, it is a person who doesn't invest any money. In this situation, okay, he can predict everything. And the problem is that there are millions of analysts, and let's say, even if there are millions of analysts, and each of them will make a random prediction, some of them will be right, and this is one of the this is a very dangerous thing actually, because sometimes you can see an analyst who predicted the crisis of 2008, predicted the crisis of 1999, and this was just because there were millions of analysts, and each of them just made random assumptions about the next crisis, and just, okay, out of that million, 10 of them were right, and okay, but this is not the argument why you should follow those analysts. And actually, there is one more interesting story. Sometimes on the internet, I think that many of you saw different advertisement about, let's say, businessman who will teach you how to start your business, how to get, let's say, millions of rubles every month, and they conduct, some trainings, and after that you will be able to earn millions. Okay, who saw such advertisements in the internet? Okay, yeah, many people. During the last year, actually, I saw a lot of advertisement with the same idea about the stock market, especially about forex. The idea is the same. Okay, I'm a trader with a very huge profitability during the last 5 years, and during the last 5 years, each month I was profitable with, let's say, 100% profitability each month. Okay, I will teach you. I'm able to teach you how to be profitable. Pay me $1,000 and you will get access to my, let's say, VIP course for trading. Okay, this is actually an example of how you can lose money even faster than on the stock market. Why? Because even previous successes do not mean that this person will be successful in future, first of all. Secondly, if you see, let's say, a biography of a person saying that he predicted the crisis of 2008, or let's say he predicted the crisis of 1998 in Russia, it means that possibly this is one of let's say 10,000 analysts who tried to predict crisis, and okay, his random guess was right, but this will not help you in future to get money, because okay, he will do some random things. And just the question for, let's say, businessmen who conduct courses about business, as well as for traders who conduct courses about trading. If you know the winning trading strategy, why can't you take $1 million and go to the stock exchange and to get 100% every month? And okay, why do you need courses for hundreds of dollars? Mistake number 12. It's about keeping losses without fixing them. We saw an example about Tesla, but that was an example of a situation when the price of stocks decreased by 8% during one day. And after that, the price now for Tesla, it's about the same as it was after that decrease. And sometimes there are situations when you think that there is a very good company, and you try to invest some money in this large company. Let's take, let's take another large bank, large Russian bank, let's say VTB. So we talked about Sberbank, so let's switch to another large company in Russia, which is on Moscow Stock Exchange. It's VTB. So this is the second or the third bank in Russia, and it is a very huge bank. It has dozens of millions of clients in Russia. And we can come up with the following strategy. Okay, let's buy stocks of a certain large company, and let's wait until the price goes up by 5%. And we think that this is a good strategy how to make 5%. Okay, maybe it will go up by 5% the next day. Maybe it will go up by 5% during a week, or maybe during, let's say, 3 months. Okay, we'll get 5%, and okay, we're fine getting 5%, let's say, during a week or during a month. But in many cases, there are situations when, okay, you invested some money in a company, but then the price starts to decrease. What we can do in this situation? We can think that the price will restore in future. Okay, this is VTB. This is a very large bank in Russia, and why wouldn't the price restore in future? And this is the strategy how to lose a lot of money. Okay, the point is that the price may never restore. For example, you buy stocks of a huge company, then the price is decreasing, 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 decreasing. Example, about VTB. In 2007, it was a very, let's say, important IPO, and it was approximately 8 years ago. And this is the price for that IPO for VTB stocks. And okay, let's assume that we used that strategy, and we just bought stocks of VTB during the IPO, hoping that they will go up by, let's say, 20%, 50%, or 10%. But it turned out that, okay, the price never increased. The current price, it's minus 50%. And if you, during the second class, I gave you the list of websites where you can see prices, historical prices for stocks. If you open VTB, you will see a very nice chart, like that. It starts from the top left corner, and it goes down, steadily, during 8 years. Okay. This is a very bright example of a situation when this strategy fails. More than that, I would like to say that the lowest price was not minus 50%, it was minus 75%. From the IPO. It was in 2000, yes, it was approximately 3 weeks ago. So actually you can end up with minus 75%. Just holding stocks of a certain company. And this is one of the mistakes. When I started my trading career, and when I started trading, I put some money in VTB. Okay. And you may guess why I included this example into the presentation.
Sorry, what was your motivation when you put money into VTB? You expected that it will store?
I described you the strategy. My strategy, which I used in 2012. And okay, first when I used the strategy, I earned approximately, let's say, something like 5%. Just using that strategy, because when the price goes down, it usually goes down with fluctuations. So sometimes it is possible to buy, then it goes up, you sell stocks, but then it will again go down. Okay, and I just bought stocks of VTB. I made 5% with this strategy. And okay, I was sure that this is a great strategy. It works. Then when I tried to use it one more time, I bought stocks of VTB, and then okay, the price was decreasing. Minus 2%, minus 4%, minus 10%. When it was minus 15%, I understood that something was wrong with my strategy, and I fixed my losses. Fortunately. And after that, okay, I decided that I will never use VTB stocks for trading. And actually, if I, let's say, if I didn't decide to fix the loss, I would have had something like minus 50% right now, or maybe something like that. Just very huge loss. And more than that, when you are following such a strategy, all your money is frozen. It means that okay, you bought some stocks of VTB using a decent sum of money, and you are waiting. At the same time, all your money, decent sum of money, is put into that stocks, and you cannot trade with using other stocks, and the price is decreasing. This is, you know, very interesting scenario. Okay, and now we have Q&A session for common mistakes. Yes, please.
Regarding insider information, what exactly is prohibited and how is it enforced?
I think I will include a link to an article about insiders into our materials on Stellar. In general, a person can be considered an insider if he has some information which is not available to everyone, which is not available to majority of people. It can be, okay, let's think of an example of such information. Some internal financial reports from that company. For example, if, let's say, if your brother works in a certain company, in VTB, for example, in the financial department, in an accounting department, and if he has access to, let's say, some private internal data about their, let's say, profits, revenues, in this case, this information will be considered, as prohibited information to use in trading. Any other questions about mistakes? Yes, please.
How do you know that the price will never restore, for example, VTB?
It may never restore. So the main point is that this is not the verb will, this is the verb may. So it sometimes it may restore. For example, when I described the situation with the VTB, I said that at the beginning I got something like 5% with VTB because the price restored. But there can be situations when the price will never restore. So you need to understand these risks. Okay, you can follow this strategy with waiting until the price restores, but you need to take into account that okay, there is a huge risk that okay, it may never restore. And in the case it restores, you can get, let's say, 5% to 10%. In case it never restores, you will get minus a lot of percent. And you can calculate something like math expectation, and it can be negative.
What is the probability?
I don't know, it depends. You can, actually, this is not exact science, so you can't say that the probability that VTB will go up tomorrow is, let's say, 51%, probability that it goes down is 49%. It is just your assumption. So, okay, I assume that it is likely that VTB goes up tomorrow, will go up tomorrow. Okay, in this case, I put probability equal to, let's say, 60% or 51%, and I will put the possible increase, let's say 5%, and I consider the opposite situation, that it decreases. I put my loss into the equation, and I calculate the math expectation. And in most cases, the way you calculate your math expectation depends on your assumptions, and only your assumptions. These assumptions may be based on some analysis from fundamental approach or from technical approach, which we covered last time, but still, in most cases, these are your assumptions. Okay, any more questions? Yes, please.
What do you consider to be a good stop loss percent?
What is a good stop loss? This is a good question. What is a good stop loss? Actually, it depends. So this is, as I said, this is not exact science. So I can only give you advice how to put a good stop loss. To my mind, it depends on the company. On the first class, we discussed companies which are considered as, which are called blue chip companies, second-tier companies, third-tier companies. And this is the issue of volatility. So for some companies, each company has volatility of the price of its stocks. So for some companies, the volatility is very huge. So it can go up and down by, let's say, 5 or 10% every day. And for a blue chip company, the volatility, it can be something like 2 or 3% during the day. In this case, first of all, it depends on the volatility. Then, it depends on your strategy. We talked last time about trends. For example, if you consider 100-day trends, so trends which last for, let's say, months, 1 month, 2 months, 3 months, you will get a larger stop loss because this is a long run. So this is, let's say, 2 or 3 months. You can get, let's say, plus 30%. In this case, you do not want some fluctuations to bother you. And if you are trading inside, let's say, inside a day, during minutes, hours, in this case, you will get small stop losses. I advise you to use small stop losses. About numbers, there are different approaches. For large companies, for blue chip companies, for weeks, for, let's say, 1 week, 2 weeks, 3 weeks, I advise you to use, let's say, 2 or 3% stop losses. For small companies, for second-tier companies, third-tier companies, sometimes you can use 5% stop losses. If you are trading inside a day, you can use 1% stop losses or half percent stop losses. It actually depends on the current situation and your attitude to risks because and the current situation. Sometimes, if you think that the certain stock is undervalued, for example, the price for Sberbank now it's about 60 rubles per share. You think that the fair price for Sberbank it's about 90 rubles per share. So it is 50% undervalued from its current price. In this situation, you understand that your gain can reach 50% in such situation. And in this case, you can put larger stop losses because it's, okay, you can take higher risks, because your profits in the let's say in the good scenario will be very high, will be huge. So it's about 50%. In this case, you can put stop losses, let's say -10% in such a situation. If you think that Sberbank is undervalued and FI price it's let's say not 60 but 66, in this case I advise you to use stop losses like 2 or 3%, because your gain can reach 10%. In this case, this is not like 50%. It is a small amount of money. In this case, you should use smaller stop losses. Okay, any other questions about common mistakes? Okay, we'll have another Q&A session, so you will be able to ask questions during the second part of the course. And now we will have a break, and after the break we will cover trading strategies and how you can... so what is the course overview? Last time we talked about approaches, trading approaches, and they gave you some general information about how you can try to understand what to buy and what to sell. Today we'll talk about the strategy, that is how you can make an algorithm of making decisions. Okay, let's say we'll have a 15-minute break. So, okay, we are continuing our class. So now, before we move to the trading strategies, we will cover some additional materials from the second class. So, in the feedback form, I fortunately received some questions about the previous classes, and from the second class there were some interesting questions. So, about breaks. Now we'll have more, let's say, strict continuation time, and we'll have more breaks. Last time we had only one break. Today we'll have 2 breaks, and usually we'll have 2-3 small breaks during the class. About a very good question about short positions. So I mentioned that there are 2 techniques, 2 ways how you can make money. First technique is when you buy some stocks and then in some time you sell those stocks. And if the price increases during that period of time, you get some money. The opposite situation, if the price is decreasing, you borrow some stocks, you sell those stocks, and when the price decreases, you buy some stocks and you just return that borrowed number of stocks. These are 2 techniques. The second technique, we can see that it's about borrowing something. And one more situation about borrowing, it's the first technique, when we buy some stocks and sell them afterwards. But when we do not use just our money, when we use some borrowed funds. For example, I have, let's say, on our demo accounts we had 1 million rubles. Let's assume that I would like to take more risks, and I would like to borrow some money. Just like you borrow some money, you can borrow some money from a bank, you can borrow some money from your broker. And you can, let's say, if you have 1 million rubles, you can use another million of borrowed funds, and you can buy some stocks for 2 million rubles. In this case, you will buy stocks for your million and for a borrowed million. And in this case, you will be able to get, twice as much as you can without any borrowed funds. It means that if you have profit, you'll get two times more. If you get losses, you'll get twice as much. And for borrowing money, when you borrow some money, actually in most situations, when you borrow some money from a bank, you need to return not just the sum of money you borrowed, but you need to return that sum of money plus a certain percent. And with brokers, the situation is usually the same. And generally you need to look at the conditions of getting some additional funds. Usually you pay a certain percentage if you transfer your position which you opened using borrowed funds, if you transfer that position on the next day. In this case, you will need to pay some commission to the broker. And the amount of that commission varies from one broker to another broker. I can say that my broker has a commission of 0.1% per day. It means that if I have 1 million rubles, if I borrow 1 more million and I buy stocks for 2 million, in this case I will have 1 borrowed million, and if let's say I buy stocks of Sberbank today for 2 million and I will sell them tomorrow, this is 1 day, this is just let's say one night. I'm using borrowed funds for 1 night. In this case, my broker will get a commission of 0.1%. It means that I will pay him 1,000 rubles for using a million for 1 night. And these are the conditions which usually can see at your broker's website. This is very important figure. As for advice, for beginners, some advanced traders or experts, they usually advise to avoid using borrowed funds and to avoid short positions, because in this case you significantly increase your risks. And if you are a novice on the market, it is better to somehow to limit your risks. In this situation, you can try to trade with your money. Okay, and sometimes you can get some borrowed funds maybe later. Okay. There were some questions about moving averages. So last time we covered the concept of moving averages as one of the techniques used in technical analysis. So there was, in the feedback form, there was a sentence about, let's calculate moving averages during the class. So calculating moving averages during the class, it takes some time, so that is why, and this is just math. So that is why I included, let's say, 3 articles about moving averages on Stellar with some calculations. If you would like to get some, if you would like to see some math with calculations of moving averages, please visit Stellar, and under the class 2 section of materials, you will see links to 3 articles about moving averages. And the point which I didn't cover last time is that we can calculate different moving averages. So they can be one of, actually there are a lot of different types of moving averages, but traders usually consider 2 of them. simple moving average and exponential moving average. Actually, what is a moving average? It is a number which takes into account the prices for some previous, let's say, days or minutes or hours. So how we can calculate a moving average? We can calculate, let's say, a 5-day moving average if we take prices for the certain stock for the previous 5 days, and we calculate average. And this calculation, this moving average, will be called simple moving average because we just calculate the average without any other techniques. Just we sum 5 numbers or 100 numbers, and we divide the sum by 5 or by 100, by the number of days or the number of hours. This is very simple technique. But what is one of the drawbacks of this technique with a simple moving average? It is that the influence of the yesterday's price is the same as the influence, as the contribution of the price which took place 100 days ago. So, for example, if we calculate 100-day moving average, in this case we sum prices for 100 previous days, and in this case the contribution of the yesterday's price and the price of 100 days ago, the contributions are the same, because we sum them without any weights. So that is why there is another type of moving average. It's called exponential moving average. In exponential moving average, we use weights. So in moving averages, we can use weights when we calculate that average. In simple moving average, we use weights equal to 1, or just without weights. It's the same. In exponential moving averages, we can assign weights in, let's say, exponential order. So the weight for the yesterday's price will be the highest. The weight for the day before yesterday's price will be lower, and so the weight for the, let's say, 5-day price will be lower, and it will be decreasing. And this is called exponential moving average. Actually, we can come up with very different types of assigning weights to a moving average. And you can see on Stellar some articles describing just the term moving average, the term simple moving average, and the term exponential moving average with some calculations. Okay. About practice and strategies. During the first 3 classes, during the previous 2 classes, and during the today's class, we were mostly discussing some approaches, so general terms, approaches. We had some practice during the first class, but it was just about submitting the order to the stock exchange. Now we will go to, in the second part of this class, we will go to trading strategies, and after that we will be able to discuss some, let's say, we will be able to discuss certain strategies. We will understand what is a strategy, and after that we'll try to build some strategies, and we'll have more practice. And okay, now we are ready to discuss trading strategies. And why should we study the question? There was a slide at the beginning of the lecture saying why do we study mistakes? We study mistakes to avoid being in 90% of traders. And here we add to this slide one more question. We add another question. Why should we study trading strategies? Or why do we need trading strategies? Because now we would like to be in 10% of traders. So the structure of today's class was the following. First we talked how we can avoid being in 90% of traders, and now we will be discussing how to be in 10% of traders. Okay, and this is actually about trading strategies. I think that it is a good idea to start with the definition. What is a trading strategy? Actually, this is an algorithm of how a trader makes decisions. The definition of this term is very simple. Yes, it's on the definition of this term is simple. And this definition includes a very important word. We know this word. This is about a sequence, let's say, a sequence of steps, which are very well defined. Now let's consider the components of a trading strategy. So actually, this is not exact science. So in different sources, you can see different definitions of a trading strategy. You can see different components of a trading strategy, but in my opinion, there are 4 components of a trading strategy. Actually, these are the following components. First of them, it's the answer to the question, what to buy or what to sell. That is the list of stocks which we will be using in trading. It means that we need to understand our trading strategies, what stocks we will buy or sell, which stocks we will not buy or sell. The second part, it's about when we need to buy these stocks. It is a very important question. The third question, it's even more important. It's when to sell. So these are 2 questions. The first question is about what, which stocks. The second and the third questions are about time. So when it is better to buy, when it is better to open a position, when it is better to close a position. The question number 4, the component number 4, it's about money management. That is how we distribute our money across different positions, across different stocks. So when we are talking about a strategy, we are talking about a situation when we put our money into several stocks. It's usually not about a situation when we buy or sell just Sberbank stocks. But it can be a strategy, but it is a very risky strategy. So the component number 4, it's about money management, so how we distribute money across different stocks. We'll go through this list one by one. Okay, the first question, it's what to buy. And this is, let's say, an important question, because we saw this 4 questions. Each of these questions, answer to each of these questions depends on the answer of the previous questions. So the answer to the first question will significantly influence the answers to all consequent questions. So what to buy? My advice for you is to make a list of stocks which you would like to use in your trading, let's say, in your trading process. What are the advice? What companies should be in this list? What companies you should choose? Actually, it depends. It depends on the risk which you are ready to take. If you are a beginner, it is better, as I've said, it is better to start with a low risk. And then you will be able to increase the risk which you can take. So, for example, in the beginning, it is better to open only long positions, not short positions. It is better to avoid using borrowed funds. And it is better to select different companies from different industries. So the first advice is here. We select companies from different industries. Why we try to select companies from different industries? Because sometimes an industry may get pressure. For example, in December, there was in November and in December and sometimes in January there were a lot of situations with the currency exchange rate of Russian ruble, and these let's say events influenced the banking sector. So these events influenced banks, and it is very common when there are. It is a very common situation when there are events which influence a certain industry. That is why you would like, and as we would like to limit the risk, we select companies from different industries just to be protected from huge risks. For example, if you buy stocks only from banks, you are under huge risk because something bad may happen to the banking sector in Russia, and usually in this situation, stocks of a lot of companies will be decreasing, a lot of banks. And in this case, you can protect yourself from this risk by selecting different industries. For example, you can select banks as one industry. You can select something about raw materials like Gazprom or let's say Rosneft or something like that as the second industry. You can select retail sector like Magnet as the third part, etc., etc. So you can take. So my advice number one is to take blue chip on Moscow Stock Exchange, and then you should divide them into sectors. For example, banking sector, retail sector, and after that you can select several companies from each sector. And you need to understand that it will be better for you to spread your money, let's say, maybe not equally, but something like equally across different sectors. So you will be protected from risks. For example, you have 1 million, you put $500,000 into banks, you put $500,000 into retail. Then after that, after you have some companies and you see each company's sector, you need to get some general information about each company. Why do we need to get some general information about the company? Because sometimes unexpected things happen. For example, there is a company called AFK System, and this is like putting money into this company is like gambling. You can earn a lot of money, you can lose a lot of money. Okay, two options are possible, and I'm not sure that it is possible to predict which result will take place. That is why it is better to get some general information about the company and to make sure that there are no huge threats for that company, there are no political threats to that company, and that you will be able to try to predict its further movements of price. And also the important information is about, let's say, profit, revenue, because for some companies, like Twitter, for some companies are not profitable, they have huge losses. We saw last time that Twitter loses $50 million every month, and under these circumstances, it can be a good idea to avoid putting money in Twitter because it can go bankrupt, and okay, your risks are very high. So according to general information about the company, you also can limit the risk. So you can choose, let's say, you can choose Apple, or as for Moscow stock exchange, you can use Sberbank. You can choose Sberbank because it's a good, profitable company. And you can choose Magnet, which is also a good, profitable company. You can choose Apple, which unfortunately is not on the Moscow Stock Exchange, but still, as an example, this is a good profitable company. And you can avoid using Twitter because Twitter is not a profitable company. That is why there are huge fluctuations with the stock prices. We saw them last time. They lost 50% of price during a year or a year and a half. And the third piece of advice is to read some latest news about the company. This is just the check. This is just to check that everything is good with the company. So there is no bad news, very bad news about the company. It is not going bankrupt. For example, there is a company in Russia called Sveznoy. It is not on the stock exchange, but it is a widely known company, and you can see Sveznoy retail stores near each Moscow subway stations. And the problem with that company is that it has huge debts. It has huge losses every month, every quarter, every half a year, every year. And that is why if this company is, let's say, if this company is on the stock exchange, I will not recommend you to invest money into this company because it's not profitable. It has a very high probability of going bankrupt. Another example is Mechel. Mechel is present on the Moscow Stock Exchange. It also has huge debts, and okay, this is also something like gambling. You can invest money in this company, you can get 100% from that company, you can lose everything on that company. And this is not the way I advise you to start with, because, you know, as for gambling, you can go to Las Vegas and you will see that the math expectation in most games is negative. Okay, there was a question.
Sorry. How likely do you think is that Sveznoy will go back?
I don't know.
3%.
But actually, I've heard that the company was bought by someone, that it was purchased by another company. So in this case, the probability is low, but still. If this company is on a stock exchange, investing money in this company is something like gambling, because, okay, the probability of going bankrupt can be 3%, can be 5%, can be 10%, it can be lower than 50%. But this is a probability that you will lose all your money. So you should understand that if a company goes bankrupt, you lose all your money you invested into this company. And this is not good, maybe good strategy to start. Okay.
Such companies have big upside of investing to them usually.
Maybe, I don't know.
No. So why people would invest them if there is no big upside?
Why people invest in company which may go bankrupt?
Yes.
There are a lot of people who like gambling.
Really?
And so at the same time, there are a lot of people who use financial projections. So this is a tough question, because the company may have debts, but first of all, there are people who have some information, let's say, information which is not available to everyone. Some people like gambling, and they just invest some money, some small or maybe huge amounts of money into that company, because it can go bankrupt and they will lose 100% of their money. But if it doesn't go bankrupt, they can get plus hundreds of percent. So
why does it happen? How can they gain hundreds if the company is losing money?
Yeah.
If there are a lot of people who like such kind of strategy.
How can they even increase? How can they even increase the number of shops?
It means that there are a lot of people who would like to risk a lot, and maybe a lot of people who know inside information, and everybody starts to buy it.
Yeah, this is a question why there are 90.
Does it happen? Have you ever seen that a company that is generally losing money gets a pump on a stock?
Twitter, yes. Twitter.
So it just goes up and down and very high.
Yes, so Twitter has huge volatility. We saw the chart last time, and okay, it was plus 50%, minus 20%, plus 10%, minus 50%, something like that. Despite the fact that the company is not profitable. It might be profitable in future, but okay, yeah, we know that on the stock market 90% of traders lose money. So we will not spend much time trying to understand why they are in those 90%. You know, we saw during the first part of the class, we saw 12 mistakes, 12 common mistakes, why people lose money. And okay, we covered those mistakes. We will, we understand them. We will not just think why other people make mistakes. Okay, when to buy? This is a good question. And the answer to that question should depend on the first question. And your trading strategy should have some exact criteria about when you would like to buy stocks. For example, last class we discussed trends. And in trends we defined a strategy. We defined the following strategy. If the 100-day moving average is increasing for 5 days in a row, in this case we buy that stocks. That was an example of the answer to the question of when to buy. And general advice is that you should have some very determined answers and criteria for this question. It should be as close to automatic decision as it is possible, And the good point about the answer to this question is that you can sometimes ignore this criteria. I mean, ignore in terms of you can. Let's say there is a stock which has certain moving average, something like that, and for 5 days it is increasing, and this is exactly your criteria that it is time to buy that stock. You can ignore that criteria. This is a good point about the strategy. An example when you can ignore that criteria: if you will not have access to the internet for the next, let's say, for the next week, for the next month, or if you have some, let's say, business you need to do, and you will not be able to follow the stocks, you will not be able to follow the market, or if you are not ready to take risks now, something like that. In this case, you can just ignore that that criteria and just save your money without buying any stocks. Okay, but if you're ready and if you see that the criteria happened, all the conditions take place, you can buy stocks. The third question, it's about when to sell. Now we are supposing that we bought some stocks. The most important question out of these 4 questions is when to sell. This is, when I started trading several years ago, That was the most difficult point for me to understand, that this answer to this question, it is the most important point, the most important question in the whole trading strategy. So it's not about when to buy, it's about when to sell. In the when to buy criteria, in the when to buy question, we saw that we can ignore this criteria. Because okay, I will not have access to the internet for the next week and I just want to save money. But if you are deciding when to sell, it means that you have already bought a certain number of stocks and you can't just wait. You can't go on vacation for a month. Or maybe, okay, you can go on vacation for a month, but when you return, you will see that it's minus 30% or plus 30% or something like gambling again. And this, I advise you to specify this criteria as I advise you to specify this criteria very precisely. It means that you should have a very, very determined algorithm of how you sell, of how and when you sell stocks. And sometimes you will have a very strong desire to ignore this criteria. For example, you purchased stocks of a large company and you put stop loss, let's say a 2% stop loss. Or maybe, okay, you didn't put an automated stop loss, you just decided that, okay, I buy Sberbank for 60 rubles per share and I will sell it if the price will go down at 55. But then the price goes to 55. Okay, you think that maybe it's just, okay, it's just an accident and it will go again back to 90 in a few weeks and this is just a mistake on the market and okay. And you may have a strong desire to ignore this criteria because now you have a criteria that if the price hits 55, you must sell it. But you shouldn't follow your desires, you should follow your strategy. Why? Because we had an example with VTB. And okay, the price went down by 50% in 8 years, and it never restored during those 8 years. So this is the risk. So when you have a strategy, a trading strategy, and you have some criteria when to sell stocks, it is the most difficult, and this is the most painful part of the strategy. Because in most cases the price decreases and it means that you lose some money. But it is very important to fix your losses now in order to avoid huge losses. And actually one more, let's say, important point. You may have, let's say, you may have 10 deals and out of these 10 deals you may get 9 deals with losses and you can get 1 deal with profit and still you can be profitable even in this scenario, because if you have stop losses of, for example, 2% for each position, you will lose something like 18%. But if you have 1 profitable position, it can get you, let's say, 30% or 50%. But if you have 9 positions with losses, and each loss is not 2%, it's 5% or 10% or 15%, as I did it 3 years ago, in this case, it will be impossible to have profits in 10 deals. Okay, and this is the most painful part of the trading strategy. And part number 4. It's about money management. Money management, it's about our strategy, how we distribute money across different stocks. So according to the first part of our trading strategy,
we have a list of stocks which we use, and we need to decide how much money we put into one stock. And the advice is that you should avoid putting all money in one stock, because this is the common mistake which I mentioned during the first part of the class. And the second advice it's putting money into companies from different industries. Actually, this is not the advice which will prevent you from losses at all, but this is an advice which can prevent huge losses. And okay, as for stop losses, I mentioned that stop losses it's approximately from 0.5% to 5% or something like that. An advice about trading strategies. If you okay, this is I have a question. How many people, please raise your hands, how many people have opened a real money account by now, by this moment? Okay, just 3 people. Okay. Actually, if you would like to practice more with trading strategies, my advice for you is to look for trading signals, so-called trading signals, at your broker's website. Actually, during the first class, we talked about the business of brokers. And their business is getting commissions from their clients. So when you submit an order and this order is executed on the stock exchange, they get some money. That is why all brokers are interested in the clients and in the profits of their clients. This is the main point. They are interested in your profitability. That is why most of brokers, let's say each large broker, has a certain system of trading signals. They take profitable brokers with long trading history, with, let's say, a long line of successes, and they maybe pay some money for the trader, and they get access to the deals of that trader. So that when that trader submits an order to the stock market, to the stock exchange, there is a notification system which sends a notification via email or via SMS message to the clients of the company who are subscribed to that trading signals or trading notifications. And you can, my advice for you is to subscribe to those trading signals if you have a real money account. I'm not sure that this is available for demo accounts, but I'm sure that this is available for each large broker on the Russian market for a real money account. And you will be able to get recommendations and notifications. And the most interesting point is that they usually write the share of your, let's say, of your money, which they advise to put into stocks, into a certain stock. For example, I have a real money account with my broker, and I subscribe to SMS notifications about deals of some people, of some traders, of some successful traders. And sometimes I receive SMS messages. And each SMS message says that, okay, it's time to buy, let's say, Sberbank, 5% of portfolio, 5% of money. Let's say if you are trading with 1 million, it means that they advise you to invest approximately 50,000 into Sberbank. And they, in most cases, they advise you the threshold on the stop loss. So they, for me, my broker sends notifications like the following: now we are buying Sberbank. We are buying Sberbank. Let's say the current price is 60. Stop loss, it's with a stop loss equal to 58. 5% of money. And okay, you can follow if you would like to develop your own trading strategy, and this is actually my advice to develop your own trading strategy. You can have a look on recommendations of successful traders, and you can follow those recommendations to understand how they, to see how they distribute money. And you can see that you can hardly see recommendations like, okay, now it's time to put all our money into Sberbank. Actually, they advise to put, let's say, 5%, 2%, maybe at most something like 10%. And this is the way they approach the risk limitations. They limit the risk. Okay, if you would like to take more risks, you can put not, let's say, 5%, you can put 50% of your money into Sberbank. But you should understand that this is 10 times huger risk. Okay. Actually, that's all about a trading strategy. Now let's take a 5-minute break, and after a 5-minute break, we will have some time for questions about trading strategies, first of all. Then we'll have some time for questions about common mistakes. And then we'll have some time, actually a lot of time, for questions about all previous classes. This course consists of 6 classes. Now it is the 3rd class, so after it we will pass half of the course. That is why I think it is important to take all questions from this class, from previous classes, and so that we can get to more advanced things. What will go next? Now we know what is a trading strategy. During next classes, we'll try to develop our own trading strategies, and this is my advice for you, to select some stocks according to this list of steps, to select some stocks, and we'll try to develop our criteria for 2nd, 3rd, and 4th steps. Okay, let's have 5-minute break. Now it's okay. We're going to continue our. Okay, now it's time for the Q&A session, and I will take whatever questions you want about stock trade. Yes, please.
So, you mentioned that publishing a strategy is bad. In the meantime, there are people who say whatever they sell or buy, right? So how can it coexist?
Yes, this is a good idea. That is why I usually do not trust to strategies which are sent, for clients of a certain broker. And my advice for you not to follow these strategies.
Have you tried?
No. At the beginning, I mean, fortunately, during my first, let's say, first educational video about the stock market, I've heard that 90 or 95% of traders are not profitable. That is why I instantly understood that if we have a strategy which can be accessed by everyone, that is why you understand what you can get from that strategy. My advice is to see those strategies just to understand the, let's say, the process, how they do money management inside different stocks. And I know that, okay, my broker, so the business of brokers, it's about taking commissions, and yes, about taking commissions, so they are interested in their clients, so that clients submit orders and they take commissions. Another point is that brokers for brokers, there are special requirements for the sum of money, and this is business where you need millions of dollars to enter the market. And in many cases, brokers usually have their own funds, their own, let's say, money, which they use to trade on stock markets. And my broker has a fund like this, and it is they use a strategy based on trends, and it gives them approximately, let's say, 20 or 30% every year, something like that. And they publish all their deals.
So you can follow?
Yes, you can follow. Why they publish the deals, and still their strategy is profitable. They publish not their strategy, they publish their deals. It means that, okay, I publish that I'm buying Sberbank for 60 rubles. Okay, I will be happy if millions of other people will know that and will trust me, because they will also buy Sberbank. After that, the price grows. Okay, I sell Sberbank, and that's it. At the same time, no one usually publishes a strategy which is profitable. Because in this case, if they publish the strategy, by strategy I mean not deals. I mean rules, that for rules. In this case, that will be a dangerous strategy. That is why they publish just only deals. And okay, you can follow those deals, but you will not know the strategy itself. In this case, they are protected. Okay, any more questions about today's class, about previous classes? Yes, please.
Is there an easy way to verify a strategy that I just invented?
Historical data. Yes, historical data. So on the second class, in the technical analysis part, I posted, I had a slide with a list of websites where you can get historical data. It's Google Finance, it's Yahoo Finance, and actually, usually every stock exchange itself gives you access to historical data. And how you can try your strategy? You need to make an algorithm as exactly as possible, so that you can take historical data and you can run that algorithm on that data. What is okay? What is not a good idea to do? When you see historical data, it's usually a chart. It is actually a long chart, and you can see fluctuations. When you see those fluctuations, actually, sometimes you think that, okay, there was a decrease, I should have bought the stocks during that decrease, then the price increased, and I should have sold stocks on that increase, on the top, buy at the bottom, sell on the top, and okay, but it doesn't mean that in future you will see the same shapes, the same, let's say, the same prices. And in this case, you need to write a strategy which decides whether you will buy or sell a certain stock based on previous periods. So let's say you have a long list of prices, you have a certain criteria, maybe about moving averages or something like that. You run an algorithm saying that, okay, it buys here, sells there, etc., and you calculate the profitability. This is actually one of the way how you can try your trading strategy, how you can test it. First of all, you need to test your trading strategy on historical data. If your strategy doesn't work on historical data, I do not recommend you to use it on the market. Because, okay, if it doesn't work on historical data, why you can be sure that it will work suddenly on real-time data and future data?
Would you advise any frameworks and software engines for that, or should I write it myself?
You can. It depends on the type of analysis you would like to perform. If you would like to analyze moving averages, or maybe something simple, you can just download quotes or prices from Google Finance, and that will be enough. And you can download them into CSV format, put into Excel, and just make some calculations. This is simple. For moving averages, it takes for me, let's say, something like 5 minutes to calculate moving averages. If you'd like to perform more advanced analysis, there are some tools for such type of analysis. My advice is to use software which is proposed by your broker. There is very wide-known software called Quick. It is QUIK, and most brokers provide access to this software. So actually, this is a piece of software you can download and install it without any, without any accounts, without any real money accounts. But it will require access to the exchange, and in this situation, you will need to enter some credentials, which your broker will provide you with. And why I'm advising you to use this software? Because Quick. Because first of all, it is connected to the stock exchange, so you will be able to see prices in real time, and they will be updated real time. Secondly, you will be able to write robots or some automated trading algorithms. So in the feedback form for the class 2, there's a question how to write robots. So this is actually the answer. First of all, you need to have a trading strategy, which can be written like an algorithm for software, for a program, for a robot. Then you need to have an API access to the stock exchange. You can get such an access with software like Quick. So I know that Quick has some API. So you install that software, you receive credentials from your broker when you open a real money account, and you write some software. So you will see in documentation how you can access API with some programming languages, or even it has an internal programming language. And in this software also allows to build some advanced charts. During our first class, we had some practice with a demo account where we saw only one chart at a time, and that was not so efficient. And more advanced software like Quick provides you with an opportunity to put, 10 charts on the screen, 100 charts on the screen, and calculates moving averages in real time. Okay, any more questions?
Do you ever calculate the derivatives of the moving averages? For example, if you want to make a strategy which has some stop points, but you also want to include the derivative calculation, for example, if the exchange was very sharp, maybe so you can postpone the decision by 10 minutes. If the exchange was not sharp, it wasn't. What do you think about such additions?
It's a good idea. Actually, I think that it is the overall idea about the speed of increases and decreases is included into exponential moving averages. So in exponential moving averages, you do not just sum 5 numbers or 100 numbers and divide them by 5 or 100. You calculate them with weights when the weight of the latest price is high, the weight of the oldest price is very low. And these weights, they somehow include the speed of increase. So I mean that, yeah, so somehow you can match derivatives and weights of exponential moving averages, or maybe just moving averages. You can use not only simple moving averages or exponential moving averages, you can use whatever weights you want, and it will move in average. Yes, please?
What is the practical border between high-frequency trading and normal?
High-frequency trading, it's usually about milliseconds. So everything which is more than, let's say, a second is not high-frequency trading.
So it makes sense to buy and sell shares in a few minutes, for example?
Yes, so my advice for you is to start from at least minutes before orders, because in milliseconds it's impossible to compete with high-frequency traders, or at least it is very, very difficult. As for seconds, still there are some high-frequency traders who influence the market, and during seconds you have some limitations of the speed of pressing a button, pressing buttons, entering some numbers, and this numbers are estimated in seconds. So still during seconds it is not so efficient. During minutes it's a good idea. So okay. And as for me, sometimes I'm trading during minutes. This is common practice for my approach, for example. So I'm trading during minutes, during hours, during days. And as for Moscow Exchange, I do not recommend to trade now during months because of the economic cycle, and I think that there will be a decrease of our stock market during the next let's say 6 or 7 months. In this case, it's better to avoid opening long long-term long positions. It's better to wait maybe a year or half a year and then to open them. Okay, yes?
What about short positions in current situation?
It's a good idea. So, in my opinion, it's a good idea, and actually yesterday I thought a lot about opening short positions. Actually, the problem with short positions is that when you open a short position, you borrow some money, you borrow some stocks, or it means that you borrow something. In long position, you do not borrow anything, unless you use some additional funds. But when you open short position, you always borrow something. In this case, you need to pay some money because, okay, some, let's say, interest rate for the borrowed stocks. In this case, for example, for my broker, the rate is 0.1% per day. It means that, okay, in this situation, I think that the price for large companies which are trading on Moscow Stock Exchange, it will decrease during next 6 months. Next 6 months, it's approximately 180 days. So if we take the interest rate, which is equal to 0.1, and multiply it by 180 days, we'll get 18%. It means that if I'm trading with let's say 100,000, I will pay just 18,000 just to cover those interest rate. And it means that, okay, my math expectation is not so high, because just to get my money back, I need all those stocks to decrease by at least 18%. And this is, okay, too much in the current situation. But the idea is good, I think. If you find a broker which has a very low rate for opening short positions, you can try it. I think that for Gazprom, I think it's a good idea for Gazprom right now, because Gazprom is near its highest prices during the previous 2 years. So I think that the price for Gazprom will be decreasing during the next, let's say, 6 months. But now I think that the decrease hasn't started yet, and that is why maybe you need some time to wait before opening short positions, just because of these interest rates. Any more questions? Okay, questions about the first class, the second class, about brokers, about trading strategies? Okay, in this case, we have approximately 10 minutes left. As for the feedback form, I will send you the feedback form tonight, so it is not included into the class. I just wanted to allocate more time for Q&A for these 3 classes. So, a clarification, which I need to make after I read the second feedback form. Okay, please fill these feedback forms. I haven't figured out yet about the pass-fail system for the ISP courses, whether they exist or not. But the criteria is that you need to fill 6 feedback forms for each class.
For each class?
From each class. So 6 feedback forms from each class.
6 for each.
Overall?
Overall, 6 feedback forms. It's okay. 6 feedback form, yes.
Each lesson has a feedback form.
Yes, each class has each class has 1 feedback form. Okay, and maybe some more interesting things. So we can finish now, or I can tell you some interesting things. Actually, I wanted to include them into the next class, but as soon as we have time now, I can tell you some interesting things about math. So now we know about how we can submit orders to the stock exchange. We know about trading approaches. We know about trading strategies. We know about common mistakes. And now we are ready to develop our own trading strategy. We need to develop our own trading strategy based on some logic, some intuition, and some analysis. And there are some points about math, because math should lay behind a trading strategy, just math, first of all. And there are some math tricks. First trick is that, let's assume that you earned 10% and then you lost 10%. What do you think? Are you still with your money, or did you earn some money? Did you lose some money?
Lose some money.
Yes, so you lost 1%. This is the point you need to understand. Let's assume that the price for Sberbank raised by 10%, and then it decreased by 10%. And in this case, it will be 1% lower than the price at the beginning. It means that if you are developing a strategy, and in your strategy you can see outcomes with you can see 2 outcomes with 30% probability for each one. Let's say plus 10% or minus 10%, and the probability of each of them is 50%. In this case, you need to understand that after 2, let's say plus 10% and minus 10%, you will lose some money. And this is the strategy of losing money, and the math expectation of this strategy is negative. Then you need to understand that there are commissions, broker commissions. And let's say if you have a strategy which gives you, let's say, 100 rubles, or you can either earn 100 rubles or you can lose 100 rubles. Still, this is a strategy with a negative math expectation because you will pay brokers commissions. Okay. that is why we can compare. Sometimes we can compare this game with. This is the argument why you shouldn't use random trading, because it's like playing with the roulette when there are the math expectation is negative. It is small, but it's less than 0. It's -1/37, but still it's negative. It means that in the long run you will lose money, in average. Okay. Some more interesting things about math. About analysts. Let's assume that there is a person who tells you that, okay, I'm a great trader, and I know everything about the market, and I can predict with 100% probability what will happen next. And and his, let's say, advice, and he sends you his recommendation once a week. He sends them in the following way. In a recommendation, he tells you, okay, now buy Sberbank. Now buy stocks of Sberbank. And hold them during 1 week. So just buy them today and sell them in a week. Okay, and you do that, and okay, you get some money. Then he sends you another recommendation. The same thing, buy Gazprom, sell it in 1 week. You use that, you use that recommendation, and you get money again. Or maybe, maybe you do not use that recommendation, maybe you just see the market and this recommendation is true. So, you do not invest any real money, maybe on demo account, or just you see the price changes, you see that, he sends you a recommendation, this is true. And he sends you first, second, third, after 10 recommendations, 10 successful recommendations, he offers you to buy his strategy for 1 million rubles. Will you agree to do that or no? Okay, do you know why?
Because then he will lose.
He tells you that, I can, my strategy is
right. The strategy already works for some period of time, and none of the strategies can work forever. So it means that this strategy will not work the next period of time.
Okay, let's say I know.
Or you will buy it and do the opposite. I don't know.
Actually, the right answer for this, I don't know what is. I can't say what is right and what is wrong, but my recommendation is not to buy this strategy, because what can I do? Suppose that I'm that analyst, I'm that trader who recommends you to buy that. I select, let's say, I randomly select 1 million people, and for the first week, I send to half of them, you need to buy Sberbank. For the other half, I sent you should sell Sberbank. In a week, we know that the price changed during the week, and I take the half which had the right prediction, and I took those 500,000 people and split again for 2 halves. Now I send another recommendation, just random recommendation. I pick just random stocks. Let's say Gazprom, and I send to half of them buy Gazprom. For the other half I sell Gazprom. And you understand that even in 10 weeks, still approximately 1,000 people will remain with 10 consequent right predictions. People who received 10 consequent right predictions. It means that if those people, pay me $1 million, or I don't know, thousands or something like that, you can calculate how much money I will get.
but how you can do this? So how you can send recommendations to what half of a million?
2 million. Okay, I can take.
I think it is prohibited because you mark this spam server. So.
Okay, let's not dig deep into some technical aspects, but okay, we can assume that I can send this recommendation to 10,000 people or 1,000 people, and this will be enough. Okay, and in this case, I will get, let's say, 10 people who will be sure that my strategy works, and okay, I'll get some money for that. That is why, if you see, it's my advice, if you see an advertisement saying that a very successful trader can teach you how to trade without any losses, you know that it's not a good idea to pay him money. Actually, the first question is, if he's a successful trader, why can't he take $1 million and, okay, trade and be a billionaire? Because, for example, for Warren Buffett, who is one of the wealthiest people in the world, with his current wealth of approximately 70 or 80 billion dollars. Sorry? 73, okay, thank you. He has been trading for approximately 60 years, and his average profitability rate was between 20 or 30, between 20 and 30% per year. It's not 100% every year. It's just between 20 and 30% during a year. Okay, and that was partially because the inflation rate in the US, because the inflation rate in the US it's approximately 2, 3, 4, 5% or something like that. In Russia, the inflation rate is approximately 10% or 15%. And that is why for Russia, the numbers should be, let's say, 10 or 15% higher. But still, if you see a person who makes 100% every year, the first question is why can't he borrow some money if he is a successful trader? Okay?
I can tell you. There is a company, high-frequency trading company in somewhere around MIT, and they make 700% per year, several years, but they cannot do bigger volume with the same strategy.
Yeah, this is, yes. This is one of the reasons, actually. Yeah.
So probably the strategy works, but you just cannot.
Yeah, sometimes this happens, but still, okay, if you choose between trying to sell your knowledge, or okay, let's say trying to sell your knowledge, and improving your strategy, or maybe transferring your strategy into another stock exchange. If you're choosing between these 2 points, if you are really a successful trader, I think that we understand what you will choose. Okay, if you have a successful high-frequency strategy, maybe you can adjust it to go to, let's say, another stock exchange. And still, so if you see a person who teaches trading for money, I think that, okay, you know that you need to be very skeptical about his successes.